I had a doctor call me a couple months ago, said he wanted to buy a 5-unit in Bellevue for $4.5 million.
Mm-hmm.
And he's like, yeah, I want to put 20% down. I make $2 million a year. I'm an 820 credit. And I'm like, hey, congrats. Those are great accomplishments. But this property needs 80% down. 80% down payment. And he's like, oh yeah, perfect. 20% down, 80. No, I'm like, no, opposite, bro. And he's like, well, what do you mean? I go, well, this is how you cash flow apartments. You know, you take the gross rents, subtract out the expenses, and you get to your net operating income. This this property before you debt service only made $115,000. So it doesn't cover, right? It's like a 2 cap.
Mm-hmm.
You know what I mean? Bellevue, Crossroads, townhouse style. So that's what we do, a lot of educating our clients and teaching them so they can go and identify a property and truly cash flow it, because that's why a lot of properties get held up for 30, 45 days and then all of a sudden goes out of contract just because
it didn't qualify.
Right?
Again, I think it's super important that we narrow down that in a commercial world, you qualify building, not the borrower.
Yeah.
And that's where the biggest misconception happens, is like, I make millions of dollars, my credit is amazing, therefore I qualify. I tell my clients all the time, that's not how it works. Hi, everybody. I wanted to bring in Joe Whitesel today, and he is my commercial lender. We wanted to kind of unpack and talk about lending around commercial real estate. There's a lot of chatter happening right now on, commercial buildings, everything, like the sky is falling and like nobody's buying and no one's doing anything. And like, oh my God, it's the end of the world as we know it. So I kind of wanted to bring Joe in today. He is my go-to person when it comes to lending in a commercial space, and just kind of, unpack everything and talk to you and figure out like what is happening, what are investors doing, and kind of like what's going on. Is it true what we're seeing, everything in today's market? And maybe even talk a little bit about how you and I met as well. Yeah, so, people can also look at networking also works. It's a big deal. So I think you and I met 10 years ago, 10 plus years ago.
10 years or so ago,
right? Yeah. I was buying an apartment complex, and then one of my agents in my office, I couldn't find anybody, referred me to you. And then I know you and I connected. I can't remember if you financed that deal or not.
Yeah, I think so. Down in Enumclaw or somewhere.
Yeah. And then the rest is history. I know I've had you a few times for my meetup classes.
Yep.
You also introduced me to Seahawks. So there was a lot that came out of this relationship at the end of the day. Long-term relationship. So I kind of want to unpack everything, talk about a few things and, see if we can help our listeners today, hopefully.
Well, I think this is a great time to talk about it, because you're right. There is a buzz. Rates are slowly coming down.
Mm-hmm.
I mean, slowly. But the banks aren't reacting to the treasuries and some of the markets moving down. So we're still kind of teeter-tottering with some of the higher rates with, some of the local banks and banks that are actually lending. But yeah, like you said, it is kind of like the wild, wild west right now. And our job at Northwest Commercial Lending is to try to navigate through this mess and help you, the buyer, and the agents understand kind of the new age of commercial real estate and lending, because a lot has changed, not only by higher interest rates or higher qualifying rates and lower loan to values, but we've seen a lot of banks say goodbye to investment property.
Why do you think that is?
Depository deposits are down, so a lot of these banks are really focusing on owner-occupied deals to get banking relationships, get their depositories in their assets back up to kind of where they were a few years ago before this crisis hit. And I mean, we're seeing some of the good low balance banks basically stopped doing. Banner Bank out here in Washington, in Oregon, they're a great go-to bank for small balance under $1 million. And yesterday they came out and said, we're not doing any more apartments.
Are you being serious?
Yes,
No
100%. So they're only focusing on owner-occupied. Bank of the West, who got bought out by Bank of Montreal, they were one of our go-to lenders for investment apartments. They're no longer doing any investment deals.
What?
So we're at this new age of really out hunting and finding who the true lenders are, right? And who aren't going to take you to the altar and leave you at the altar with a full package.
So the ones that are lending, what are they doing? Like, are they putting you through a meat grinder as a borrower before they give you money, or what does that even look like?
Yeah, you know what? Not a lot has changed. The underwriting requirements are all the same. The difference is, instead of underwriting at like a year and a half ago at 4% or 4.5%, now we're underwriting at 7%, right? And now that you see the treasuries and the FUB, federal home loans, coming down, those markets are coming down, the banks aren't moving their spreads and they're not moving their qualifying rates down, right? So even though we could get someone at 6.25% right now, 6%, because where the markets are, they're still underwriting the deal at 7%. So you can't use that 6% to get someone into the deal. So in markets like Seattle, the low cap rate markets, it's still a 50% down market, right? When you head out east and Midwest, as you know, buying in Alabama and some of the markets that you've bought in, you can still get into deals at 7.5 or 75% LTV.
Can you talk a little bit about the LTV and what that means? Because some of our listeners are newer.
Yeah.
It might be their first time, and they might not know what that means. I see a lot of times people come in. I guess let's just talk about the difference between buying a fullplex, like a duplex, triplex, fullplex, and or buying 5+ units, 10 units.
Yeah, it's a great lead way.
Yeah, on the fullplex, the down payment is 25%.
Yeah,
right?
I mean, really, on a 1 to 4 unit, you could, if you don't put it into an LLC, you could buy it as a second home or an investment property based off of your income. So if you're a high net worth earner and you're not worried about putting it into an LLC on title, then you can use your income and your credit
to qualify.
Okay. And
Okay.
so you could go 20% down potentially, right? In the DSCR, debt service coverage ratio, in apartment type lending, we could do 1 to 4 units, but they have to close into an LLC, right? At closing. And so when we do those type of loans, we're not looking at your credit. Well, we're looking at your credit. We want to make sure you're a 680 or higher. But we're really focusing on the property as is, and then we'll look at your assets, and we're not including your income. And so where a lot of people stumble is you have a lot of new investors that have been in that single family buying fix and flips and using their income. They're high net worth individuals, have an 820 credit. They come to me and
I make $2 million.
Yeah, example, I had a doctor call me a couple months ago, said he wanted to buy a 5 unit in Bellevue for $4.5 million. And he's like, yeah, I want to put 20% down. I make $2 million a year. I'm an 820 credit. And I'm like, hey, congrats. Those are great accomplishments. But this property needs 80% down. 80%
down payment.
Down payment. And he's like, oh, yeah, perfect. 20% down, 80. No, I'm like, no, opposite, bro. And he's like, well, what do you mean? I go, well, this is how you cash flow apartments. You take the gross rents, subtract out the expenses, and you get to your net operating income. This this property before you debt service only made $115,000. So it doesn't cover, right? It's like a 2 cap. I mean, Bellevue, Crossroads, townhouse style. So that's what we do, a lot of educating our clients and teaching them so they can go and identify a property and truly cash flow it, because That's why a lot of properties get held up for 30, 45 days and then all of a sudden goes out of contract just because
it didn't qualify.
Right?
Again, I think it's super important that we narrow down that in a commercial world, you qualify building, not the borrower.
Yeah.
And that's where the biggest misconception happens is like, I make millions of dollars, my credit is amazing, therefore I qualify. I tell my clients all the time, that's not how it works. We need to look at the building, how much money is it bringing, what are the leases doing, how much are they paying on their lease, what can we do with their rent. That gives you freedom to play around and take it to the lenders that will entertain that building. It's the building. You are buying business, essentially, so you're qualifying business. And I think that's where, like we were talking about the rookies, when they come in, they get all flustered, like, what do you mean I can't buy?
Yeah, I mean, like you mentioned with the athletes and, you working with Cliff and a lot of the people that we work with, and I get these high net worth athletes call me. And I'm like, yeah, man, or they're retired former athletes and they don't have a W-2 job and they want to buy a small deal where we have to have income. And they're like, well, what do you mean? I got 20 million in the bank. And I'm like, yeah, but you don't show any income right now. It's like you're retired. You're not even getting 401k income. You're not old, or you're not getting that retirement income kicking in yet, right? So
how would one break into that?
Oh man, kind of like what we did with you, right? We love coaching and educating, number one, and love teaming people up, right? A lot of athletes or high net worth individuals want non-recourse loans, right?
And what does that mean? Can you touch base for a second?
So non-recourse loans are, you're not personal guaranteeing the loan. And so if something happens at no cause of you, you don't burn the place down or do something illegal, they can't come after you if you foreclose on the property. And so it's not on your personal credit. Well, none of these loans are on your personal credit, 5 units and above. But the non-recourse high net worth individuals like that factor. If they fail on the deal and they foreclose on it, the bank just takes the property. They leave your other assets alone. And so, but there's not a lot of those loans, as you know, and
so who offers them?
They're a little bit harder to get into. Our agency lenders, Fannie Mae, Freddie Mac, and they have really they have some difficult requirements, and this is how we kind of navigate through those requirements by adding partners to the deal that have experience. So Fannie and Freddie want you to have either 2+ years of experience owning a 5-unit, or they want you to live within 100 miles of the property. So sometimes, kind of like your situation, if you're buying out in Alabama and you live in Seattle, it's a little outside that 100-mile radius. So we have the abilities to put people in place with other experienced investors like you and team up so we can help them get experience. So now they'll get that 2+ Fannie Mae experience or agency experience.
And the benefits I know of having a Fannie Freddie loan, that agency loan, is not just the non-recourse portion of it. They also have favorable interest rates.
They have some of the best terms out there. What I like to tell people is if you're at the top of your, if you're not looking to pull any cash out down the future and, like, hey, you're only going to get bumps and you want to not, just, you're going to live off the cash flow bumps, right? You don't see, you're at your height, right? Fannie Mae 10-year fix is kind of like your end loan, right? Like you're parking it away. And the reason why is they have pretty large prepayment penalties, right?
And the prepayment penalty is usually yield
maintenance,
which means
it's tied to the yield of the market when you got in and when you're getting out, and there's a calculation because they're making up the gaps of the years of the interest, right?
So I'll bring an example. You financed one of my apartments, Wedgwood.
Yeah.
I bought it during COVID. I think the yield maintenance, it's the Fannie sets their rate based on a 10-year treasury. It dropped down to a
1 year.
It was like under 1%. It was like 0.09.
It's because the market completely changed.
It was during COVID, and I was so brain dead for not buying more properties, but that's a different conversation.
Yeah, no, they also have a step down prepay too.
Yeah, and I think my rate on that one is 2.5% commercial loan. My rate with Fannie Mae is like 2.5. I can't remember what it was under 3%.
Right around 3. Yeah.
I do have prepayment penalty, but again, if I sell it today, I won't have to pay it because Fannie Mae will essentially make more money off of that loan with the 6% interest
so they're
rate.
only going to charge you there's a minimum 1% prepay.
Right. In that particular situation, it's okay. But let's say somebody financed today, they're at 7% interest. And
it's going to be like a 9 or a 10% prepayment penalty.
Right.
When the rates go down to 4.
5 years down the road, rates are down to 4, then they're paying that.
Now, the good thing about Fannie and Freddie is they're one of the only lenders that allow second mortgages.
Interesting.
So you got a big property, you're at 6% right now, rates go to 4, and your prepay, let's say, is like 7%. Well, that's not smart to pay that off.
Mm-hmm.
Now, you could, if you need a second mortgage, you could go and get a Fannie second or Freddie Mac. They allow seconds.
And how long does that prepayment last for? Is that 10 years?
9.5 years.
9.5
So
years.
it's always, they give you 6 months out to refi, sell, do whatever you need to do. Open. You know, the other thing too, though, is they've gotten really aggressive on their products. I mean, if you look at the treasuries right now, the 10-year and the 5-year are trending the exact same. So Fannie had, these Fannie and Freddie, they have some 5-year with some, you're going to pay more in premium in the price, in the rate, but there's a 3-1-0 prepay. There's some different options for people. And in some ways, they're pretty aggressive loans, and we kind of use those loans in some ways like a short-term bridge, right? Because if your prepay's up after 2 years and you're free, I mean, now you could go from a 6.5% potentially down to a 5 or 4.5 at no penalty. And we're doing a lot of short-term, a lot of short-term debt right now, but safe short-term debt.
What is a safe short-term debt?
We're not talking like C paper money, like hard money bridge. I mean, we are doing a lot of that, right? Because there's a lot of properties that are just under market rents, need just gut job cleanups. But if you have a property that has already been upgraded and you're buying it, but it's just below market rents, and we could get you in on a pro forma deal or use a 3-year fix without a balloon payment, where after 3 years, if you're not ready to refinance, it'll automatically lock into another 3-year at the market, right? So we're teaching our clients about goal setting. The very first thing when a client calls in, I'm asking, like, hey, what are your goals with this property?
That's a good question.
And the reason why is because I'm not in the business just to throw a loan at you. I could really screw up your financial goals because we talk about prepayment penalties, right? 98% of these loans have prepayment penalties. Or 98% of these lenders, I might say, have prepays, right? There's only a few that don't offer prepays, and the ones that don't offer prepay, they're harder to get into.
What makes it hard?
Just higher debt service coverage ratio requirements, maybe a lower loan to value, instead of you being at a 75, they're saying, hey, we're only going to 70. Or they might charge an origination fee, which then I say to my clients, well, look, that's in some ways that's like a prepay buyout, right? But I'm always looking to talk to my clients about their goal setting, because if you tell me that, hey, I want to be in this property or I want to we're repositioning these rents. I want to be in this loan for 3 years, and then I want to refinance out. Well, I'm not going to put you into a 10-year fix with a yield maintenance or a step down prepay where in year 7 or year 3 you got a 7% prepay. I mean, that just does no one any good. So I want to kind of mold the deal around what they're thinking, right? The average apartment owner, in some ways, refinances their apartment every 2 to 3 years until you're done at you're tapped out of your pulling out cash, right? And then that's when a lot of people throw it into the Fannie Mae 10-year fix. And the other cool thing about Fannie Mae is, they're fully assumable, right? So if you do get into a rate at 4% and someone wants to assume your property, they can assume that rate for the remaining terms.
But then that borrower still has to.
They still have to come in with the difference.
Qualify.
They still have to qualify
him the
right?
way they would qualify him if they were to buy something new.
So the goal setting to us is, really important, because now we kind of get an idea, and then it helps us as our loan officers gauge the deal, because then we know, hey, in 2 years or 3 years, we're going to have another loan, right? And so we're using short-term, 3-year, 5-year fixed products. Bridge lending is hard money lending, 2 years ago.
What do those rates look like?
I mean, depending on loan amount size, it could be as low, maybe 9%, the lowest I've seen. That's like $2+ million bucks, bigger deals, right? Stronger markets. The average bridge rate right now is 10 to 11%. Then you still have your hard money guys at 12 and charging 4 points, right? But people are still doing them.
And why would somebody go into bridge lending? What would push them to do something like that? I know we did it. So
yeah, but it worked out. In some ways, worked out well for you guys. There's a lot of banks, like we talked about earlier, are shrinking, right? So a lot of our community banks and some of our banks that we would really depend on to be able to do these kind of bridge loans, like we have some community banks that we'll give you, back in the days, we'll give you 5.5% interest only for the first 2 years. You get your work done, and then after 2 years, it goes for the remaining 3 years, it goes to the fully amortized rate, right? A lot of those banks are done. They're not done. They're still lending, but they're not doing those products because of the market. So you have to revert to some of these higher interest rate bridge lenders. The other thing that there's a lot of ugly eyesores out there, right? Mismanaged properties, even our pro forma lenders that we can say that we could take them to and say, hey, look, this property works based off pro forma numbers, and it should on paper, but when you go out and look at the property, the roof's falling down, siding, it just looks like you don't even want to get out of your car.
It smells like money.
Yeah, it does smell like money.
You either make money or you're losing money.
I did a hard money loan, on my deal in San Antonio, and I bought literally, if I took my wife to that property at the time, she would have looked at me like, what the hell are we doing? Like, but, I bought it for $450 with a hard money loan. 8 units.
8 units.
In San Antonio.
$450, you did hard money loan.
Hard money loan. They gave me, I put 25% down. They gave me $100K in rehab funds on a draw schedule. We got 7 out of 8 because I still got some old dude that does not want to move, and he's paying every month, and I'm just like, okay, I'm not going to kick you out. I could have one unit left. But I took my studios from when I bought it. They had a couple of people in there that weren't paying, but their lease agreement was $400 for a studio. I took my studios from $400 to $650, and our one bedrooms from like $550 to $800. And now that value in San Antonio, which is actually a really hot apartment market, because I'm on Government Hill, so I'm right by big military base, and we have 7 out of 8 rented right now. We just had a military guy move out because he got
called for duty.
Yeah, called. So, but yeah, I feel like my property's no less 900. We've doubled that value.
Amazing.
Yeah, San Antonio's a growing market.
What's your rent on it now? You said it was 400.
Yeah, I'm getting. There's 4 studios and 4 one bed, one bath. So I'm getting $650 for the studios, and I'm getting $800, and then I have one bedroom that just signed up for $850. So I'm just like, okay, why not?
It's perfect.
It's cash flowing. Let's roll.
Amazing.
So yeah, so you know, hard money serves its purpose. And the way I like to sell hard money is, hey, if I go back to the seller and say, look, we're buying this property from you, but guess what? Here's your new price, or you're covering my closing costs, or because I'm jumping on this bomb that you created and giving you pretty, you know, a good amount of value, right? Because we see the future value, but I'm not going to pay him for what we think our future. Why reward someone for having it be a dump, you know? And that was like my place, you know, and that's something that you got to do your research on these properties too, right? As you know, I get people that call in all the time. Have you know, they buy sight on scene, and I'm like, you know, no way.
Are they newer investors?
Oh yeah, they're investors? You know, because they're used to buying single families and doing fix and flips, and they have an agent go out and walk them with the phone. And I'm just like, no way. I want to drive the neighborhood. I want to see what my next door neighbors look like.
100%.
I want to go meet property managers. I want to, you know, go.
100%. People get lazy. I've seen videos of these gurus saying, like, you don't need to see your properties. You just buy it sight unseen. Let me teach you how. That just makes my hair stand up on the back of my neck. I'm just like, what are you people doing? You want to pack millions of dollars into a building you've never seen. I had a deal under contract a couple years ago. I think I had you look at it. You said everything pencils out. It was in Birmingham, Alabama.
Yeah, I remember that one.
That one? I mean, cash cow.
Yeah.
And my husband and I are chatting. I flew out there. I always fly out to see my properties. I get it under contract sight unseen, but I will show up for an inspection. I fly out there, drive the neighborhood, and just something just doesn't feel right. I'm like,
just kept on driving.
I'm like, what is going on? Did the inspection, and I'm still not feeling warm and fuzzy.
Is that the guy that had the gun on the table?
That was the guy. Yes, you remember the story that had the gun on the table. He had it slap right in the middle of the table. He was like, what are you doing here? And that didn't scare me. That doesn't bother me. I'll tell you what bothered me. I called my friend who's Jamaican. He can be rough around the edges. FaceTime him. I'm like, hey, Pete, take a look. What's going on here? And his exact words, and I quote you, get the fuck out of there right now.
Yeah.
Every home was crispy burned.
Oh, my gosh.
Or they were sliding off the face of the earth, like the foundation was sliding or something was happening. Even if I was to turn those units around, that was still my competition.
Yeah.
Because guess what investors are going to do? They're going to come, they're going to fix, flip these homes, and now this is an affordable housing that competes with my building. There was too much of that happening where I was just like, I can't do that.
Yeah.
This is not me. Just did not. I literally was on my way to the airport. I had extra 15 minutes to spare. I turned around, called my husband, and I was like, I need to go back and tour. Like, instead of going east on this road, I'm going to go west on this road. And I was just like, what in the world is this? So we backed out. It was a cash cow. It was over $200,000 a year in cash flow. Just could not do it. So that's another thing to our listeners, like, don't buy something just to buy something.
Yeah, and you hear just because one person went into that market doesn't mean
it's
everything.
Exactly.
I mean, we do so much work for so many different investor groups, and so we see a lot of these deals, and sometimes we'll see the same deal from 10 clients. And
they're all
looking at it, right? And someone will get on their contract and they don't do their homework or they don't listen, and find out there's 3 murders at the property. You find out, this happened, and banks Google properties, and they look and they'll call out stuff. They're smart. People don't think underwriters are smart. They don't just look at the numbers. They're gonna they want to make sure where they're putting their bank's asset or their money is going to work.
But like in my particular situation, we've bought buildings that have had plenty of issues.
Oh, yeah.
Where we've had, people.
I mean, there's workarounds. Yeah, you've
but
had
they
issues. Yeah.
will land to you if you are going to turn that building
Oh,
around
100%.
and if you have a plan. And when I tell people you're going to put a resume together, you're going to have a business plan. And they're like, what do you mean? What does that look like?
I get the same.
It's, again, like you said, it's
I
about
ask them,
educating
give me a
our
pro forma.
clients.
What's a pro forma? Well, a pro forma is your 12 months of projected rents and expenses once your property is stabilized. Well, how do I put that together? Okay, well, let's talk. And so and that's a lot of the coaching and then educating that we offer, because if we can't make you, the buyer, better you're never going to be able to buy any properties, right? I mean, it's not like, no offense to residential lending, but it's not, here's my W-2, here's my pay stub, give me a pre-approval letter, right? I get people that call me and say, hey, can you just issue me a pre-approval letter? I got $500K in the bank, and just say I'm good up to $2 million. And I'm like, I can't do that, because you might go get a property under contract for $2 million in Seattle,
which won't qualify.
But you're not going to qualify with $500,000 down. Well, what do you mean? It's because that property is a minimum 50% down. Right?
Again, you're qualifying.
You're qualifying the building.
That's the key to our listeners. You qualifying the building. I cannot stress this enough. I was dealing with the client, not my client actually. I was dealing with an agent yesterday that's trying to guide her client on a transaction that I'm doing, and every question he was asking was wrong. He doesn't know what he doesn't know, and the agent doesn't know how to guide this person. And my heart was just bleeding. I'm like, oh my God, just dial him in. We're all going to jump on a call, and I will guide you step by step on what needs to be done. But he was asking questions. We had a tenant that moved out last month. We put a new tenant in, and he wants to know if the previous tenant was paying in the past 3 months. Why does it matter?
Yeah.
He moved out.
Yeah, I mean, you do have some
questions.
lenders, as we know, and like Fannie Mae, if it's an apartment, you have Fannie Mae, Freddie Mac that need 90% occupancy for 90 days. So you want to, and they're going to, but that's stuff that we work around, right? There are a lot of questions and stupid questions that come up.
There are no stupid questions.
Well,
in our industry,
yeah,
I've seen
there are
plenty.
no stupid question, but it's. The biggest thing is, like what we're talking about, is how do we pre-qualify a buyer, right? Because it's really not about the buyer's income, right? It's not about it's about the property. So if they don't have a property, how do we pre-qualify these people, right? I mean, half these people that get into the commercial industry don't know about the paperwork that goes in. A personal financial statement, schedule real estate owned, is the very first thing that someone should fill out.
And what does that look like?
So your personal financial statement is, you fill it out on a residential loan application, but on one side, we're going to list all your assets, your cash on hand, stocks, bonds, mutual funds, savings, checking, real estate values, every single real estate property you own, your single family, all your investment properties. So preparing your personal financial statement the correct way is very important, because we have some lenders that, even if you don't have experience, they have net worth requirements, right? You need to have a certain net worth, 1-to-1 ratio to the loan amount, or there's so many. The unique thing about our industry that I forgot to mention is every single lender is different.
That's true.
Fannie Mae and Freddie Mac, they all have their guidelines, but if you walk into Bank of America, they're not offering a Fannie Mae apartment loan. Correct. Bank of America doesn't do loans, right? So Fannie Mae and Freddie Mac, the agency lenders, that stuff's strict, right? But every community bank, credit union, paper bank like Chase, WaFd, Wells Fargo, the big box banks, everyone's different. They all sell the same products, 3 or 1 year, 3, 5, 7, 10-year fix, amortized over 30 years, 25 years. But how they get to that loan amount or where they lend is different. Like I tell people all the time, like they'll call me up on a property in Spokane and say, "Hey, I bank with Chase. I'm just gonna go get a Chase loan." And I'm like, "No, you're not." "Oh yeah, I am." Chase doesn't lend in Spokane.
No.
And they come back to me 2 weeks later, like, "Oh yeah, can you help me out here?" I'm like, "Yeah, okay. I need a 2-week extension."
So in your ideal world, let's say these people are educated, because we're educating my people that I'm going to send your way, right? What are you looking for? Like, come talk to you first.
Yeah, that's a great question. I think the best thing is talk to us first before you go out and put an offer down, right? We'll write a pre-approval letter. We're a broker, but we're correspondent, and we represent. It's not like residential where if you're licensed in the state of Washington, you could do a loan anywhere in the state of Washington, right? We don't have to be licensed as a loan originator. And so our lender list is just huge, right? So I could say yes on every single loan, but it might not be the yes that you want to hear. But I want to coach you up front. I want to educate you so you are asking the right questions, collecting the right documents. You have your personal financial statement filled out, because you give me your personal financial statement and I see how much cash on hand you have. And you bring me a deal, I could come back to you and say, "Hey, look, you don't have enough cash. This doesn't work," right? You can't write an offer on this unless if you have a partner or someone else that's going to bring in cash. So we're going to analyze that with you. And then we want to analyze these deals as you're analyzing them, because we could help you analyze these deals and make a decision faster on the property, and help you get under contract faster, because the name of the game is, if it's a good deal, there's
10 other people looking at it,
right?
And everyone.
And if you come and we present their financials, sometimes I could even present it to some of our banks and get a letter of interest from the banks. And so that could go in with your offer with our pre-approval letter. So trying to collect as much data. There's some owners, as you dealt with in the past, that they don't have any records, and you're like, "Do you file taxes?" Like, yeah, but I don't file my apartment, or I don't owe anything on my apartment, blah, blah, so it's like
scary. I've seen it.
So we have to start recreating documents, rent rolls, profit and losses, pro formas, whatever, to try to take it to a bank that will want to lend on that deal, right? There's so many outlets out there. And that's the thing that I think the general people and the public don't understand, that there's so many commercial lenders. You hear a lot of the big box banks is not doing stuff like we talked about earlier, but there's so many banks that we know that are creative, they're hungry. Some of them want depository relationships, like move $100,000 into our bank or $50,000 into our bank, we'll give you a better rate. So our job is to get creative and find a home for all these loans that are coming across our desk. And we're starting to see a good amount of deals,
What do you see like experienced investors are doing right now? What's working?
I'm starting to see a lot of these experienced investors leave these markets. And
these markets as in our area?
Yeah, the low
expensive markets.
Yeah, they're kind of going in some ways where you're going, right? Mississippi's, the South. Housing we need housing, even out here, you see apartments going up all over the place, right? And that's the other thing. We do construction loans. We have construction lenders that are back and they're hungry right now, because the way these banks work is it's like a pie, right? They slice up, we're going to do X amount in apartments, X amount in this hospitality, SBA or whatever, and then this fraction for construction, right? And once that bucket is full, they don't do anything until they get a payoff. So imagine here in this market, the last 3 to 5 years with all these cranes up everywhere you go. So all these banks were tapped out. So now a lot of these apartments are cashing these banks back out, their exit
Right.
loans. So we're starting to see some credit unions and some of our community banks in this market do construction that sometimes now it might pencil a little bit better, right? But yeah.
In terms of like when they go out of state and they invest out of state, what is that cash flow and or cap rate? I mean, personally, I think cap rate is stupid, but what does that look like?
Oh, well, I mean, I tell everyone once you go east of Colorado, things change, right? And it truly changes not only for like cap rates and properties, but it changes the lending terms also. All these banks on the West Coast, I mean, everyone in the country offers the same, 1 year, 3, 5, 7, 10-year fix, right? That's what, they're fixed arms or fixed rate mortgages. But when you're on the West Coast, west of Colorado, west of Arizona, 95% of our lenders offer a 30-year amortization. When you go east of Colorado and you're in the the plains and the Midwest, Southeast, Southwest, Northeast, they're 20 and 25-year amortizations. And the reason why I bring that up is we buy these properties for cash flow. We're not buying these properties to pay them off, right? It's not like your American dream to pay off your house.
Correct.
We're using it as an income-producing cycle. So when you drop a 6.5% interest rate on a 30-year, your cash flow's this.
A little better. Yeah.
And then you put a 25 in, and then you put a 20 in.
Yeah.
You're even lower. And what people don't understand is it makes it harder to qualify for the property because you're chopping off that cash flow. The debt service completely changes on the property.
What are some of the creative ways? I mean, I know what they are and I might give you my opinion, but what are you seeing like on the 20-year, 25-year amortized loans? What are they doing to improve their cash flow?
I mean, it's increasing rents, right? I mean,
that was my answer.
Yeah, the name of the game. Increase rents, and then try to, if you're in a property has a 20 or 25-year am, some of those banks in the Midwest and some of those other markets that aren't as aggressive, their interest rates are crappy too out there. Totally different than we are out here. Like sometimes I'll talk to my guys in Alabama or Tennessee, and I'll ask them, I'm like, well, where's the 30-year am? Or you're offering a 8% and a 20-year am? And I'll be like, out here we're getting 6.5 30-year am. What am I missing here?
Why is that?
And they look at me like I got 3 heads on my shoulder, like, what are you talking about? And I'm like, well, this is what we see out here. And so a lot of those banks don't have prepays. So I kind of go back to like that conventional bridge, right? Hey, if they're going to get you into this with this amount down and it works, then get into it, reposition the property. You don't have a prepay. Then when rates come down or more banks start coming back to the market, then we could look at better options, right? Or if you're close to $1 million, then you could hang in there for a year. You're going to put $100,000 in, or then we could maybe try to get you into a Fannie Mae loan, right? Because those will be the better terms.
So I want to talk a little bit about repositioning properties, because that might be also a newer concept to some people, or they don't know. Like it's kind of like outside of their comfort zone. How do I increase rents? But I can't do that. So when we come in, my husband and I, when we purchase our properties, I look at, like, I don't care what the owner did. I don't care how they run that building. I know how I am going to run it, and I know what I am going to do to it. We come in, we take care of all the health and safety issues ASAP.
Yep.
Whatever came up on the inspection, we do that. And I look at the leases, like that's the most important thing I think investors need to start considering when we say reposition your building, you're going to stabilize your building. This is what we're talking about. You're going to look at all your leases. How much are my tenants paying? $400 on a 2-bedroom unit. They've been there for 20 years. Yes, my heart bleeds for you. I'm sorry. It has not been updated for 20 years. What are we going to do to it? We're going to put new floors. We're going to put new boom, 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 make a plan. And then what is the going rate? And I usually look on hotpads.com, which pulls out data from Zillow and everywhere else.
Is that similar like rentometer?
Rentometer, yeah. But it'll tell you, for that particular zip code, if you're off by like whatever many dollars, if you think the rent needs to be $1,500 on a 2-bedroom and you said, I'm going to charge $1,300, it'll tell you you're off by $200, right? So then I know if I do X, Y, and Z on a $400 unit, I could be charging $800. That's how you stabilize that building. Keep in mind that process will take a year to 18 months to 2 years.
Yeah.
It's not an overnight thing, because chances are that previous owner was a slumlord and they did not run it well. And that is why you're buying it.
That's why you're buying it. And that's
people
why those
get
people
so
are
hung up on it.
That's
like,
why that long-term guy's been there for 20 years.
But the fence is broken. Yes, that's why you're buying it at a dirt cheap price.
Yeah.
But there's a pothole. Like, yes, that is what you're going to fix.
It's a gravel driveway.
It's like not a big deal. And I think people that are newer, like the rookies, they just get so hung up on little things that don't matter. They're fixable. You can fix it. Even your drug dealers and the prostitutions, call the police, have random.
Well, here's the thing. Once you start cleaning
patrolling
up your property,
they go away.
Yes, they do go away, but your neighbors start they're like, oh my God, this guy, like in my property, like I was trying to buy the next door neighbor because he got pegged by the city for basically remodeling or rebuilding this house into like a fourplex without permits. Oof. And so I was trying my hardest to get that, because then now I could turn, now I got a 12 unit next.
Right.
But he saw me starting my remodel. And so that's when they started, doing theirs, and they got pegged because, of course, I went the right way and got permits and did it the right way. And as you start repositioning these properties, it's terrible. You feel bad when you have a 10-year tenant in there, but they know they're taking advantage of the current owner, and they know that the current owner's selling, so it's just a matter of time, right? You could offer them Section 8, if they're not, hey, go get qualified. Maybe I can move you into one of my new updated units.
Yeah, we do that.
And you qualify for Section 8. Well, okay, instead of you paying a full $400, now you're paying $40, and Section 8's paying
the rest.
$500, right? And so that's another thing. A lot of people think there's awful, like the Section 8 tenants are awful. Those are your best tenants.
Hands
seriously. I mean, you're getting guaranteed money from the government every single month. B, they have tenants that do not want to move out. They're paying you, and they know, like, here's my 40 or my difference. They're getting a deal, so they want to stay there. If you have a great unit, they're not caught. They're normal people. They're people working at grocery stores, the servicing industry. They're normal people.
They just need a little help. You still qualify.
They still qualify, and you have a background check.
Exactly.
It's not like you're just taking Billy Bob off the street.
Yeah. Oh, let's see. They got a pulse. Let's go.
Oh, yeah. Hey, you need a unit? Let's go, man.
That's funny.
I got you a nice one in San Antonio. But, I think, like you said, I mean, going into these markets and these different cap rate markets, it's a different environment. It's a different cost of living, right? I mean, it's crazy what you can buy in the South right now.
Cap rates don't take mortgage payment into consideration.
No, cap rate should be where the interest rates are, really, right? I think it's all about cash.
Yeah.
But when you get out to these, like where you bought, I mean, you got it. Huntsville is totally different now.
People were getting.
I get in arguments with Paul and these guys. I'm like, you tell me why Huntsville is like Bellevue, Washington. Oh, well, we have Amazon. No, Amazon's from Bellevue. We got this. No, they're from Bellevue. That's why Bellevue's a 4 cap. And you're trying to sell
Are they trying to sell it?
These guys have still 5 caps. I see floating around 4.5 caps, in Huntsville, which is a great market. But then again, explain to me the growth that's going to capture that market. Just because there's fulfillment centers or Amazon's moving a headquarter there. That's not gonna.
Wait, are they moving?
I don't know. I mean, you just hear.
I was gonna say
no,
what?
not like not
That
no,
would be
not the
amazing.
headquarters, but you know what I mean, like an office.
They do have a fulfillment center. They
So
do
I
have a
tell people, I'm
warehouse,
like,
yeah.
you know, just slow your roll a little bit. Let's really, but you like, I have client that is just turning and burning in Jackson, Mississippi right now. Like he bought
Flipping or buy and hold?
buying, like flipping these not houses, big
Apartments.
apartments. Like he used to be from here. He moved down south. He lives in Florida now. And I did a ton of stuff for him in Tucson. He just bought, I did it for him. It was like a 76 unit in Jackson. And we did a bridge loan. And they gave him $500K for rehab money. And we closed the loan like 8 months ago. And he bought it for 2.5. And he has it under contract right now for like 4.1.
No way.
Yeah.
How much did he put in it?
He put 500 in, I think, and 25% down.
Amazing.
So he's like 700 in. So he owes like basically almost like 2.8 on it.
Amazing.
And so now he's under contract with the property right next door to him. The guy failed on his rehab, ran out of money, stopped making his payments. It's in receivership. He's under contract on that one for 2.8, and he's going to do the exact same thing.
Moral of the story today: there's money to be made.
There's a lot of
in
money to
any
be made
market.
right now.
Figure out
And that's the
what
thing.
works.
It's like, here, a lot of people come to me and they're like, oh, I just want to stay in the Washington market. Or I live in Seattle, but, you know, I'll go to Spokane. You know, I'm like, okay. So you'll go to Spokane and you're going to drive in the winter 4 hours through the pass in the snow to go see your property. You're still going to get on an airplane. So what's the big deal of buying in Arizona or
4-hour commute still.
Alabama? Yeah, I mean, you're going to get on an airplane, right?
Yeah.
And your cash flow, your mailbox checks are going to stack up a lot faster than. I mean, don't get me wrong. I love Washington. I'm not here to. I mean, it built my business, and you and we've done so much work together. But it's just a harder market for a buyer to get into.
It is hard.
The West Coast is just a totally different market, right?
Yeah.
And it just takes more cash,
Yeah.
which there's a lot of cash out here.
Yeah.
So
That's awesome. No, this was a lot of information. I'm glad
no, I think this is great.
we
Thank
were
you.
able to unpack it. Anything else you think we forgot to talk about?
No, I mean, God, we could sit here for probably another hour.
To unpack more
No,
things.
I always, when I talk and coach people or do talks, I always tell people at the end of my talks is, if it's not me as Northwest Commercial Lending or one of my guys that works for me, seriously find a commercial mortgage broker, because they're going to really, if they're experienced and they have, I mean, I've been doing this 17 years, right? And so we built a pretty good reputation, and because we want to coach. If you find the right team that believes in what you're doing, then you're going to be successful. And if you use the right tools, right? Just don't get caught up in a contract because the agent tells you it's a good deal.
Right.
Right.
That's important.
The agent wants to get paid.
Yeah.
Okay. We charge a 1% loan fee, right? The agent makes 3% on a deal.
Take it to you, which is what I always do every single time
Yeah,
I come across
and get it
something.
pre-approved, because you don't want to lose your earnest money. You don't want to
I
be
always
like,
need
holy
your
crap.
eyeballs on it. I always
Yeah.
call you. I'm like, Joe, take a look at it. What am I missing? What am I not
And
seeing?
so that's my biggest take. I tell people is use us like a sponge. I do not charge upfront fees, right? I'm not going to say, hey, give me a deposit like some brokers are doing because they're desperate for,
Making money.
we close enough loans where we don't need to do any of that. And we don't get paid by the banks. So I'm not trying to lobby this to one bank so they could send me a referral fee. I mean, that would be great, be a lot more money in my pocket. But no, it's not like residential where I can cover your closing costs and move, it's
Right.
so broker, and a lot of these banks won't accept packages from the normal, borrower.
Yeah.
They say, hey, we have to have a broker present the deal to us. So that's another thing. So,
Love it.
but networking, kind of like you and I, you know, if you have partners that want to go in the deal with you, The unique thing about our industry, and I forgot to mention this, is it's not like residential. We don't need a season assets. So you could go find a partner and say, hey, I found this property. You want to dump some money into this deal. I don't need to be like, hey, go put that money in a checking account for 60 days, like when you're buying a home, right?
Yeah.
We don't care what's on your bank statements.
Yeah.
And so the ownership structure, LLCs, all that. So it's not as hard as everyone thinks it is to get into an apartment deal.
You just need the right person on your team to guide you through the process. At the end of the day, Joe Whitesel, Northwest Commercial Lending, out of
and
Kirkland.
Nelya, because Nelya, go get some loan or go get some deals. Have Nelya write up the contract, and then we'll get things rocking and rolling.
Yeah.
You know,
That's awesome. I like it. I think we're good.
Yeah.
We can, thanks for coming out. Thanks
I
for doing
appreciate it.
this with me.
Thank you.
And we should do this again for sure.
Yeah,
I'm
we
sure
love being a
there's gonna
resource, and we should even, like we talked about real estate agents, we should team up, and the more we could teach agents about how the process works, because as you know, the residential industry is just blah, right?
Yeah.
You're on the news talking
Blah, blah.
about how crazy it is,
Yeah.
like there's no offers or this and that. So now you get all these realtors out there trying to find their next paycheck. Well,
Oh my God, 2 seconds and I'll be done, I promise. I was told yesterday that pending transactions are down 98% this month.
it's insane.
That just, holy
I
smokes.
saw something.
I could not believe it.
I saw something that 50% of the residential loan originators did not renew their license
Oh my
for
Lord.
2024.
So that's going to, again, clear out the industry, get rid of a lot of riffraff that was
Yeah,
in
the
it for the money.
the one-time
They
agent
were in it for the money,
do 2 deals a year.
Exactly.
Yeah,
Which is not a bad thing at the
but
end of the day.
it's always good to try to find those. Kind of like what we've done, meetups, right, and teach realtors how to cash flow a deal, like how to look for a commercial deal. Because
I'm actually doing a class next week. How does it pencil out? Is the name of the
that,
class.
I mean, that's an amazing class because
People don't know. I'm just like, what do you mean you don't know?
well, and
That's
that's
just like-
the same thing as like what we talked about, that doctor that tried to buy that 5-unit in Bellevue, right? The agent's like, I'm gonna write this up for you. Like some dude comes in and says, hey, Nelya, can you write this contract up? This 5-unit for $4.5 million. That agent, that's not an experienced commercial agent, $4.5 million times 3. What's that? 150 grand or whatever.
That's all they look at.
Yeah, they see that ding ding ding.
That's all they look at.
And then I got to come back to them and say, hey,
It's not gonna.
you
work.
need 80% down, bro.
I had somebody come to me the other day and they said, I have an excellent home for you in Initai. It's a perfect investment opportunity. I'm like, oh, I'm all ears. Let's go. And they're like, it's like a $7 million home and they'll rent for $15,000 or something stupid, $20,000 a month. And I'm like, I can't fix stupid. I'm not even going to argue. Like, I'm not even going to talk to you right now. You're stressing me out.
Yeah, you need a little bit more.
I was like, how is that a great investment opportunity? I was like, what are you talking about? It's sad how many agents don't know
Yeah.
investment world.
And you also have to be careful, not only with the agent, with some of the loan brokers too. A lot of residential guys are
Dabbing
into trying to close apartments, and they'll quote. I mean, yesterday I got a deal over, and this guy only has a week left on his contract. He went down some road with a residential loan officer on a 6-unit in Arizona. And
I was going to say, is this mine?
No, it's just, it was and what they were quoting, and they had all these high fees in there, and it just didn't work.
I have one.
So that's where one of the deals I have to flip into a hard money deal to save the deal, because this residential loan officer wasted his time 40 days not presenting him BS basically.
I have one I'm dealing with right now. It's a residential lender. I'm on a listing side of it. They took on the deal. Some leases are on a year lease, some have 6 months, some a month to month, and the lender comes back and says, I need all the leases to be on a year lease. I'm like, no, you don't. And they go, yeah, we do, because that's what underwriter's asking for. And I'm like, no, you do not. Tenants have the right with landlord, same thing. They both have the right to keep each other on a month-to-month lease. If that's what they choose to do, then that's what it is.
It's a sale.
And it's a sale. You want it month-to-month. Yeah. You don't own the damn thing. I'm not going to put them on a year lease. And then they're like, okay, fine. You gave them notice of rent increases. We need it signed. I'm like, read RCW. You do not need notices signed by both parties. It's a notice. You're just giving a notice. Here's a notice to you. Like some of the questions that are coming up, I'm scared. Like,
well, and it's
supposed to close next Friday. I don't know if we will.
Some of these lenders drag you through the mud because sometimes they're just trying to find a way to, they keep on throwing out underwriting.
Underwriting, yeah, she says it's underwriting.
Well, they keep on throwing out underwriting, not guidelines, but conditions, and hoping that they don't want the deal. Yes. Right. They don't want the deal. So they're trying to find a way to say, oh, it was denied. Sorry, we're not going to do the deal.
To get out of it. That could be it.
And so honestly, every bank, I'm not joking, terms, guidelines change like underwear, and so
experience
like you change your
matters.
Underwear. Yeah, and it really does, and it's knowing where to take your deal and who you're dealing with too. So
yeah, experience matters. If anybody needs anything, they can get a hold of you through
my email, joe at nwclending.com, or we're in Kirkland. nwclending.com is our website. Northwest Commercial Lending.
Perfect.
I'm here to help out. We got a great team, great processing crew, and we're here to do deals.
Awesome. I like it. Thank you so much for coming out today.
Thank you for having
me. We're going to do this again,
Amen.
hopefully.
Let's do it.
And unpack some more. Thank you.
Let's do it. Thank you.